So good afternoon. This is Tina Powell, business consultant here at Beacon Wealth Management. I want to take a minute to thank everyone for joining us for today's webinar. And again, apologies for the technical difficulties we had at the top of the show. The topic for today's webinar is third quarter 2018 market update. Your presenters for this broadcast are Mark Germain, CEO and founder of Beacon Wealth Management, and Christopher Cacchiola, partner and managing director of wealth management. Please keep in mind that this presentation represents an assessment of the current market environment at a specific point in time, and it is not intended to be a forecast of future events or a guarantee of future results. This information is intended to be educational purposes only, and you can find a copy of today's presentation in the Handouts tab within your webinar viewing panel. This webcast is being recorded on Wednesday, October 31st at 11:05 a.m. All participants have been placed in listen-only mode for the first part of our broadcast. Should you have any questions, please type them into the chat and save them for the latter part of the broadcast. You will have the option of asking your questions live or through the chat at the conclusion. Please do not use your name, and if you are experiencing any technical difficulties, you can call our office at 201-447-9500. And now, let me welcome Mark Germain.
Thanks, Tina. Welcome, everyone, to Beacon's third quarter market update. Today, Chris and I are going to provide a bit of a macro view of the last quarter, which, of course, it was going up nicely, and then we hit October, and a brief overview kind of of the Beacon portfolios and what may actually be affecting you most, rather than just kind of the overview of what's going on. If you have any specific questions regarding your portfolio and you want to take them offline, please feel free to either send us an email or give us a call. I want to get right into today's agenda, kind of beginning with the trends that we witnessed in the third quarter. I think it's really important to note, and Chris will talk more about this, is that we've been through this many times in the last few years, 2016, 2015, 2011, okay? So this has all happened before. It didn't shock us as it happened. We were actually ready for it, which Chris will talk about. So the first is rising GDP growth. Second is September's unemployment rate, which is a record low. Next, we'll talk a little bit about Fed policy and rising interest rate. And we already saw one rate hike in the third quarter, and we truly are expecting another before the year is up. Despite what current administration may kind of grab at the Fed and try and get them to succumb to political pressure, we don't think that'll happen. Finally, I'll say a few brief words on corporate earnings and take a quick look at the sectors in the S&P 500. On Friday, so let's talk about Department of Commerce Bureau of Economic Analysis, that's the BEA, released advanced gross domestic product estimate for the third quarter. What did they find? A growth rate of 3.5%. Interesting is during the past 4 quarters, GDP had risen maybe about 3%, and it had started to rise about 3%, which was above the 2.3%, which was the year before. So literally about a 30% increase. This last GDP number shows 3.5 annual percent growth rate from July through September. So the number's big, 18.7 trillion, which, is just a lot of zeros after that. The increase in real GDP in the third quarter reflects positive contributions from personal consumption and private inventory investment, which means companies are building up inventory, state and local government spending, federal government spending, and non-residential fixed investment. All of this is good for the economy. So again, when we talk about it, how it affects your portfolio, these are positive signs. The second GDP estimate for the third quarter is scheduled to be released in November at the end, Wednesday the 28th. Let's talk about unemployment. Our last unemployment reading of 3.7% is the lowest unemployment in 50 years, longer than many people that are listening have actually been alive. It's the lowest jobless rate since December of 1969. And the number of employed persons decreased by 270,000 to 6 million. Clearly, the U.S. labor market remains strong. If we take a look back to July and August, those readings were only 3.9. So hence, big improvement. Be careful not to forget what this kind of affects. It affects wages. It's going to affect inflation. It's going to reflect career movement. So all of these things start to happen. Again, if people are able to move from a career perspective, that's good for the economy. If we actually see a little bit of inflation, that's good for the economy. If employment is up, wages start to go, people spend more money. So over the year, the unemployment rate and the number of unemployed people declined by 0.5 percentage points. And that's a big number. That's 795,000. If you look at the graph, which I think it's already up on your screen, you can see we are still well below the 4.1% that was back in January of 2018. So it's interesting to note that back in January of 2015, we were actually at 5.7%. So employers may find going forward that it's increasingly difficult to find workers. That's one of the sidebars of a low unemployment rate, difficult to fill positions. So we're anticipating the jobless rate will probably remain low for a while. If we go back a month to September 26th, in a joint meeting of the Federal Open Market Committee, that's FOMC when you hear it on the financial press, and the Federal Reserve Board, a decision was made to raise the target range for the federal funds rate by 25 basis points, or 0.25%. So it moved to a 2.25% rate. It looks like we're on track for another rate hike for December. And given September's unemployment rate, which we just discussed, I think the Fed has a keen eye on unemployment and recognizes that it's okay to continue to raise interest rates. Also, personal consumption expenditures, that's what you and I spend, that price index, how they measure that, is up as well. So this looks at what businesses are selling or we're buying. And that's going to be released next week. And we think compared to August reading of 2.2%, it's actually going to be up. We heard from a new Vice Chair, Richard Clarida, last week in his first major policy speech at the Peterson Institute for International Economics. That's where he was speaking. In it, he said more rate hikes are likely appropriate. And it's kind of what we're thinking that, we've been saying for the last 4 years that it's okay if interest rates go up. And we've always said that they continue to go up very slowly. We think that's going to continue. Of interest to you might be the op-ed piece that appeared in Bloomberg last week by former Fed Chair Paul Volcker, where he says there's no theoretical justification for a 2% inflation rate. And we kind of agree. We can't grow the economy at 2%. He has a new biography out, good reading, The Making of a Financial Legend, and it literally was just being released. The S&P 500 firms in the third quarter posted profits that exceeded Wall Street's expectations. This is not our data, but it comes from FactSet. To date, almost half, 48% of the companies in the S&P have reported earnings for the third quarter. Of those companies reporting, 77% have reported actual earnings per share of stock above their average or their mean earning per share estimate. The earning per share estimate come out by the research community. So it's also interesting to note that the earnings per share estimates are above a 5-year average of 4.6%. So kind of due to these EPS surprises, earnings growth rate for the S&P 500 has improved to 22.5% from October 26th and from 19.3% on September 30th. So you kind of take a quick view of the graph. What's this really telling you? We can see that tech and the community services sectors performed above estimates. However, We know this number will be reduced in the fourth quarter based on recent earnings announcements and all of the activity, Facebook, Amazon, all the technology side. Let's take a little bit broader look at the economy. And based on all the data that we've been pulling together and that we read, if we look at October 26, we can see pressure on both equities and bonds. Chris will talk about October, which we had an increase in the call load to the office. That is this 2008 all over again, and we'll tell you that no, there's no reason to believe it is. But Chris will talk about that. Finally, I want to take a minute to talk about the U.S.-China trade wars, or what is building to look like a trade war, which is putting pressure on the market for sure. We think the next round of tariffs, if they're imposed, which will have a trickle-down effect on everything from tech and apparel to travel and leisure, are going to affect both American taxpayer as well as the market. Leading economists from Citigroup predict the impact of a 10% tariff on the $267 billion of imports could be 10 times larger than the first $50 billion round and double that of the $200 billion in tariffs in the second round. So all the numbers, what's it mean? That Citigroup is predicting that if they truly do impose those tariffs, that there actually is going to be an effect, and we will feel it in the market. It's, again, not something that is new to us. It's not something that we don't watch. We actually are looking at it on a regular basis. So we keep track of that every single week. Anyway, I think we're going to kind of turn it over to Chris Cacchiola and talk a little bit about the Beacon portfolios in Q3 2018.
Thanks, Mark. So as you mentioned, solid growth and strong corporate results continued in the third quarter, really propelling markets mainly in the U.S. to a very good quarter, with the S&P up over 7% in the third quarter alone, driven mainly by large gains in the technology and healthcare sector. Tax cuts, as we mentioned on our last call, continue to be a key component, as they are providing support for corporate profits across the board. But as we enter the end of year 2018, policy headwinds have begun to increase, mainly around the Federal Reserve, and fears that they are becoming too aggressive with their rate hikes. And as we've seen over the last few weeks, investors have begun to take notice. Throw into the mix the escalating trade tiff between the U.S. and China, and you can understand why we began to see economic data here in the U.S. and globally begin to soften a bit towards the end of the summer. Mainly here in the U.S., we began to see real weakening in auto and housing data, which has been two of the key pillars behind our positive outlook the last 3 years. That positive outlook has not changed even through the current market correction. What has changed, however, is that for the first time since really 2015, Beacon has begun shifting away or changing which sectors we favor going forward. So at the portfolio level, Beacon has began making changes really since July. First, it began with the fact that we have not invested all new cash since the summer. And that was mainly due to what we just discussed. In the summer, we saw some of the macro data changing, and that caused us to pull back from fully investing as we have over the last 2 years. Another big change for us is that over the last 3 years, on these conference calls and with meetings with clients and conversations, we have consistently favored what we call cyclical sectors of the market, mainly financials, industrials, materials, technology, things tied to the economic well-being of the economy itself. While we still favor many of those sectors, we are no longer overweighting them, and we are beginning to shift more towards what we call defensive sectors. And last week, you saw some of those changes as we added REITs into the portfolio, the symbol USRT, and we began to bring down our allocations to our overweights in industrials and financials and technology. Another key area we continue to watch heading into 2019 is the international and emerging markets. While both outperformed the U.S. in 2017, 2018 has been a very different story, as in almost all areas, they are down over 10+% for the year. Most of this is being driven by the stronger dollar and trade war noise that Mark mentioned earlier over the summer, both of which we believe will be temporary, hence creating an opportunity for us to increase allocations to areas of the market that are, from a stock shopping perspective, much cheaper than the U.S. currently. We will also begin adding to utilities and consumer staples over the next few weeks into the portfolio. The market has corrected over 10% since October 10th, from peak to as of yesterday's close. And while all corrections are painful and very quick, the recoveries in many cases are just as quick. We have created cash in all portfolios, have between 8 to 15% in cash, ready and waiting for what we believe will be an opportunity over the coming days and coming weeks. On the fixed income side, we will also begin to reevaluate. Over the last few years, we have always favored what we call credit risk high yield bonds tied to the economy. And as we mentioned, while the data remains very good, we will begin to properly rebalance a little more towards higher quality bonds because high quality bonds provide more of a base to portfolios in market environments like we're experiencing now where stocks go down.
Thanks, Chris. That's kind of, there's a lot of information we're getting you to digest and come across. What's really important is to understand that on a regular basis, literally every single week, all of these numbers we're looking at, which allowed us in the summer to actually start increasing the liquidity in the portfolios, not investing new cash, and putting a hold. One of the things that the investments group does here is actually puts holds on investments. So we may have had an investment that we bought 2 years ago that did extremely well. Just because it did extremely well doesn't mean we want to continue to buy more. So there is constant monitoring of what's going on in the portfolio. And that's why when clients call in markets like we have right now, and we try to calm down kind of the froth that comes over the last few weeks, that it's not indicative of what's really happening in the marketplace. So before we open it up for questions, I want to take an opportunity to share information about our next upcoming events. First, we have a Beacon Breakfast Roundtable, which some of you have been in our office for that, on tax reform in the age of the longevity economy. And it's taking place in our Florida office on Thursday, November 29th, between 9 and 11. And that's in Palm Beach Gardens, Florida, right on PGA Boulevard. So space is very limited, as you know, just like our conference room here. We keep it to about 12 to 15 people. So if you'd like more information, please call our office at 201-447-9500. Ask for Carla Castillo, and she takes care of all the activities and everything that's going on. And we're trying to keep her as busy as possible. So please give us a call. The second event is our annual holiday party, which has really become something that the team here, as well as just about everyone who can get to it, just loves to come to every year. That's our open house. It's going to take place again on the Thursday, a week after the breakfast roundtable. but it'll be in our offices here in Hackensack from 6 to 9 p.m. and right at 505 Main Street in Hackensack, New Jersey. It's about, as you know, about 15 minutes from the GW Bridge. We'll have plenty of food and refreshments. It's a great chance to unwind from what normally is holiday stress and enjoy a fun evening with all of us and catch up on all of the Beacon announcements that we'll be giving you then. So please call our office again. Call Carla Castillo, 201-447-9500, and just tell her, yep, you're coming.